NATO 2025 and global trade risks, what it means for markets this week. Welcome to Money Minded, where every week we break down the most important financial events shaping global markets and explain what they mean for your money. If you're looking for insights that go beyond the headlines, and if you want real stories from the front lines of finance, you're in the right place. This week, all eyes turn to Washington, D.C., as the 50th NATO Summit kicks off. But this isn't just a geopolitical event, it's a signal for how the world is aligning economically in 2025. While most people see NATO as a military alliance, what's unfolding right now has deep consequences for markets, supply chains, currencies, and even entire industries. Why? Because this summit is happening against a backdrop of escalating global trade tensions. Talks around China, Indo-Pacific influence, critical technology exports, cybersecurity, and new NATO defense supply agreements are already causing ripple effects in the global economy. Defense budgets are expanding. Trade corridors are shifting. And markets? They're watching closely. We'll explore exactly how this high-level summit could affect the companies you invest in, the currencies you hold, and the global outlook for everything from commodities to semiconductors. Investors are beginning to reposition based on the potential outcomes of these talks. And for smart traders, this is not a time to sit on the sidelines. In today's video, we'll break this topic down into clear, actionable chapters. First, we'll explore what's happening at NATO behind closed doors, what leaders are debating, and why it matters. Next, we'll turn to the economic data and political signals that are already emerging from the summit. Then, we'll give you a clear map of the trade and investment sectors most exposed to what's being decided this week. Whether you're an investor, a business owner, or simply trying to stay informed, understanding how defense alliances shape global financial policy is more important than ever. NATO is no longer just about military defense, it's a frontline player in economic strategy. So stay with us as we take a deep dive into the crossroads of diplomacy and finance. Hit that subscribe button if you haven't yet. Because Money Minded brings you powerful financial storytelling every week, and this is one you won't want to miss. Chapter 1. But beneath the surface lies a far more complex financial story. What's really happening is a reshaping of global trade architecture. One that could influence everything from semiconductor policy and energy security to the flow of international capital. So what exactly is at stake this week? At its core, this year's NATO summit marks a pivotal moment where economic security is now inseparable from military security. In closed-door sessions, top leaders from 32 NATO countries and partner nations in the Indo-Pacific like Japan, Australia, and South Korea are hammering out not only commitments to military readiness but also new strategies to protect critical supply chains, secure rare earth minerals, and counterbalance China's influence in trade corridors and tech platforms. One of the major agenda points being closely watched by financial markets is the formal expansion of NATO's role in coordinating technology standards and export controls. With the rise of AI, quantum computing, and cyber threats, NATO members are pushing for a unified approach to restrict key exports, especially semiconductors and military-adjacent hardware, from reaching adversaries. That's sending signals to markets about possible tightening in global tech trade and investment controls in sensitive sectors. Moreover, defense budget coordination is getting serious. NATO's 2% GDP defense spending target is being revisited as a minimum threshold. Nations like Germany, Poland, and the US are pledging even higher allocations, investments that could benefit aerospace, cybersecurity, and defense contractors. Investors are taking note, rotating capital into firms exposed to these long-term procurement plans. But the summit also surfaces friction between NATO's economic goals and broader global trade rules. Tensions with China are particularly sharp. While NATO avoids naming China as a military adversary, economic language in the summit's communiques paints a picture of strategic competition. There's increasing alignment among Western allies on reshoring production, diversifying energy supplies, NATO's engagement with Indo-Pacific partners is drawing significant market attention. Japan's Prime Minister Kishida has made strong calls for an economic NATO framework to deter coercive trade practices in the Asia-Pacific. This would mark a bold shift, creating new strategic trade blocs that bypass traditional WTO structures. So what should investors and analysts take away from this? The NATO 2025 summit is not just a diplomatic meeting, it's a global economic signal. It shows that the post-Cold War model of free trade and open capital flows is being replaced by a more fragmented, security-first model. For financial markets, this means new risk parameters, new opportunities, and a need to closely track geopolitical developments, not just earnings reports. In the next chapter, we'll map out how these developments are already being priced in, from currency moves in the euro and dollar, to rising share prices in defense stocks, and shifting capital flows in emerging markets. Stay with us, this summit is setting the tone for how markets will behave for the rest of 2025. Chapter 2, How Markets Are Reacting, Capital Flows, Defense Stocks, and FX Signals. 1. Defense Stocks. Strong buy signals from NATO commitments. One of the most immediate reactions has come from the defense sector. 5% or more, investors are flooding into aerospace and military technology firms. In the US, shares of Lockheed Martin, Raytheon, and Northrop Grumman have seen renewed upside momentum. In Europe, aerospace and defense ETF, ITA, have outperformed broader indices since the summit began. This move suggests investors anticipate long-term procurement contracts, boosted R&D budgets. Dollar remains resilient as Washington reasserts global leadership through NATO, reinforcing its role as a safe haven during geopolitical uncertainty. Meanwhile, the euro is facing mixed pressures. On one hand, stronger fiscal coordination within NATO boosts confidence. On the other hand, growing trade divergence with China threatens Germany's export engine, a key pillar of the Eurozone economy. But analysts are warning that if NATO trade strategies escalate tensions with Beijing, Asian currencies sensitive to China's trade volumes, like the South Korean won and Malaysian ringgit, could face fresh downside volatility. 3. Commodities. Rare earths and energy in focus. With NATO prioritizing supply chain resilience and energy independence, markets are seeing a spike in interest around rare earth elements, uranium, and liquefied natural gas, LNG. The EU and US have already signaled strategic stockpiling efforts, and investors are rotating into mining equities and critical resource ETFs. Oil markets are watching closely. If NATO's Indo-Pacific partnerships deepen, including closer ties with Australia and South Korea on energy strategy, it could reshape shipping routes and investment priorities in the global LNG sector. WTI crude and Brent prices have remained stable this week. But geopolitical analysts warn of long-term price support if NATO-backed energy corridors disrupt existing supply chains. 4. Bonds and credit markets. Eyes on government defense spending. Bond markets are also digesting the summit's implications, with more NATO countries planning to increase defense spending. Sovereign bond yields in the EU and UK have ticked slightly higher, signaling anticipation of increased government borrowing. However, US Treasuries have remained well bid. Credit spreads have widened marginally in industries like automotive manufacturing, semiconductors, and shipping. 5. Crypto and emerging markets. South Africa and Brazil are at the center of attention. Their currencies and sovereign debt may come under pressure if the NATO-led economic realignment accelerates. In the final section, we'll walk through practical strategies for investors and businesses, how to hedge these risks, spot the new opportunities, and what to monitor in the weeks following the summit. Conclusion: global power plays, market moves, and what you should do now. As we wrap up this edition of Money Minded, this year's summit solidified NATO's evolution from a purely military alliance into a wider geo-economic bloc, with explicit pledges to counter China's growing influence, deepen ties with Indo-Pacific allies, and ramp up collective defense spending. This isn't business as usual. It's a global realignment, and markets know it. Defense budgets are ballooning. Trade policies are being redrawn. Alliances once purely military are now trade-driven. These are not isolated moves, they're system-wide shifts that ripple through capital markets, supply chains, and global monetary policy. We've seen how the market is already reacting. Defense and cybersecurity stocks are gaining momentum as investors bet on a multi-year upcycle in military innovation and procurement. Currencies like the US dollar and Swiss franc are reaffirming their status as safe havens, while the euro remains torn between cohesion and export fragility. Commodities, especially rare earths and LNG, are drawing speculative flows due to supply chain reshuffling driven by NATO's strategic autonomy goals. Bond markets are adjusting to new spending pressures, with investors weighing sovereign debt risk against geopolitical instability. Even crypto and emerging markets are not insulated. Bitcoin's quiet strength amid NATO's policy convergence hints at its growing appeal as a geopolitical hedge. Meanwhile, countries on the fringe of this trade recalibration, like Brazil, Vietnam, or South Africa, face rising scrutiny over their positioning between the West and China. So what should you do next? Position for defense exposure. As trade tensions deepen, currency volatility will increase. Hedging exposure or diversifying into safer currency zones may protect portfolio value. Follow supply chain news closely. Energy and rare earths are at the heart of the new economic battlefield. Stay informed about mining, energy corridors, and export bans. Monitor bond markets for spending signals. Government defense commitments will impact yields, especially in Europe. Stay crypto aware. Digital assets may see new use cases in cross-border payments, sanctions evasion. Stay tuned for our next episode, where we dive into how crypto markets are preparing for macro pressure this month, including the Fed's CPI decision and CME Bitcoin futures volatility.